Hello, it's your financial friend Maggie. Welcome to the Inside Out Money Podcast. Hey, Andrew.
Hey, Maggie.
Hey, can we get rich quickly?
If you're an influencer on Instagram, absolutely you can get rich quick.
Yeah, right. But do you think someone can get rich quickly? One word answer.
Yes, if they're lucky.
Oh, okay. I thought you were just going to say no. I like the yes if they're lucky. Just like lottery
Anybody
winners.
can win the lottery, right?
Yeah.
Somebody bought Bitcoin when it was $1.
True.
Right? Somebody invested in Meta on opening day.
Right?
Right?
You're right. Not me, unfortunately, but okay. Welcome to the Inside Out Money Podcast. This is a personal finance podcast focused on redefining wealth from the inside out. Each week, I speak with a rotating set of co-hosts about a different financial topic to help you improve your financial mindset and tactics. Today, we have your favorite, because he's the one here today, co-host Andrew, and we are going to tear down.
Liz and Erica might have a bone to pick
Well,
on.
Erica
that
doesn't
one.
listen to the podcast.
That's a good
Liz
point.
is the
right?
only one who's going to get upset. Greg doesn't listen. He's not really.
So my competition is Liz now. Is
Your competition is Liz. And this is like your favorite child is whoever's in front of you in the moment asking that question. So we've got co-host Andrew here, and we are going to tear down the quote, get rich quick fantasy, because growing wealth isn't sexy. There's not a viral TikTok hack that's going to get you wealthy. We believe it's consistent long-term work, yet we are bombarded with these schemes that promise some sort of a shortcut when they mostly aren't and could actually harm us. And this all started because someone I know sent me a very detailed, I'm going to say scheme. He wasn't trying to I don't know. It was just a lot. I say scheme have a
slightly negative connotation to it.
Connotations is a word. But I will say the definition of a scheme is a large-scale systematic plan or arrangement for attaining a particular object or putting a particular idea into effect. So that definition does not have a negative connotation. That's actually the perfect use of the word scheme. But it has, I think, become, the term like pyramid scheme and other things attached to scheme have implied that it, has a negative connotation. But he sent me a very specific financial recommendation, right? And it highlighted this core problem that is out there, which is we are all looking for an easier path. And there are people, and algorithms especially, that are ready to sell us a map to this path that might actually lead nowhere. So we're going to dig into this. I'll share a little story. I shared this story with Andrew Monday when we caught up in person this week. And we got into this nice philosophical discussion about it as we do. And then we were like, this would be a great episode topic.
This is one that I get pretty passionate about and have a lot to say on it, unlike a lot of the other topics.
That's true. You're a man of few words at times, but the words you say matter.
Yep.
I am a woman of many words, and few of the words I say matter. I just my word to value ratio is different than yours. Let's put it that way. I can say that because it's about myself, okay? Just since I teased the sort of, scheme I say, the recommendation from somebody included a quote of quote on money printer. And that my red flags are up anytime someone claims they've got a money printer of an idea.
Well, if I had a money printer, I would not be telling anybody about it either. That's the other thing.
I hear people say that all the time. If I have this brilliant investment opportunity and it's such a sure thing, yeah, I'd keep it for myself. I wouldn't tell everybody else. I wouldn't be trying to get money from everybody else for it. So this particular idea this person was talking about was selling covered calls, which I'm not even going to get into what selling covered calls is because it's not the purpose.
We could do a whole episode on covered calls and options trading, but we'll skip that.
It's not the purpose of today's episode, but there's entire people who have written books about how you can, retire early by selling covered calls, how you can make, quit your job and do whatever. There's people who make money day trading. There's people who make money doing all sorts of things. But in the scenario this person gave me, the math of what they were assuming was a 30% return on their money by doing covered calls. And also that it was just easy. Anybody could do it, which is not true. Mm-hmm. And our point is, Andrew, you said something so brilliant when we were talking about this, and I wrote it down. And then when I complimented you about how brilliant it was, you were like, well, that's kind of the spirit of like everything Morgan Housel says.
Mm-hmm.
So I was like, I appreciate that you gave
I'm always
credit
channeling
to
my
your
inner
bud.
Morgan Housel.
Yeah,
right?
You do a great job doing that. But the thing you said, which we're going to talk about this more at the end, is you said that people have a hard time conceptualizing that the easiest, most uncomplicated strategy is the best.
Right. Yeah.
Right? They think a more complicated strategy is better, but that's actually not true most of the time for the average person. Again, unless they're just lucky.
Yeah, and I think that we've talked about this quite a bit, that when it comes to people confuse luck for skill when it comes to investments.
Yeah.
And I come back to Warren Buffett, the greatest investor of all time, which his track record has definitely got some skill to it. He says to his wife that if I pass, put it all in the S&P 500.
Yeah, it was in his will, right? Yeah.
Right. And so, or not if, when he passes, put it all in the S&P 500. But this is, it is hard for the human mind to wrap your head around this, to say that something that is simple, uncomplicated is actually the better approach.
Best path. Yeah.
And the entire financial industry is fighting against this concept, because in order to justify the fees and their entire existence, they have to come up with these big, crazy, complicated strategies to say that, hey, this is why you're going to work with me, is because we do it
You
this
need to
way.
rebalance quarterly, and I'll do that for you. You could never do that on your own. It's too complicated, right? They make money off of complicating things.
Right. And I'm going to divide my asset classes into single percentage points, right? We're going to put 3.4% in gold. We're going to put 8.3% into a REIT. We're going to put 42.3% into stocks, not 43.4, but 43.3. It's got to be that, right? And so, or we're going to do some crazy option strategy. We're going to invest in precious metals, or we're going to, all of these different things.
I've got a big lead on this great opportunity, this great investment opportunity that's going to double your return.
The other one I love is we have access to private markets.
Yeah.
We have access to investments that you can't touch. And those are, that's how they justify the existence, right?
Yeah. Okay. So let's talk about a bunch of concepts and things that we think you all should keep in mind and that will help you to spot and recognize and understand these things that really are often a bad idea for you to do with your money if your goal is to grow your wealth over time in I was going to use the word safe, but that's not even the right word. In a simple, uncomplicated way.
Right.
Yeah.
Yeah.
Let's talk about risk and reward for a minute.
Yeah. So this is also another one that I think people confuse a lot, is that when you hear these wild returns, right, that you can make 15, 20, 25, 30% on your money, many people are not evaluating the amount of risk that you're taking on with that when your people are kind of, quote, guaranteeing those kinds of returns. And even if you look at the market, I'm just going to use companies for example, right? Yes, you hear about the Apples, the Nvidias, the Googles of the world. You know how many tens of thousands of companies that are in the graveyard in bankruptcy court, right, that didn't make it? Those were some of the few that did. And there's an entire, every single one of those companies likely had some investors, if they weren't self-funding or cash flowing it themselves, right? There's some investors. And the whole venture capital space is built around, hey, we're going to invest in 100 companies and we may have one or two Googles that really take off and fly, and that essentially cover all of the sins of all the other ones, right?
Yeah.
And so there's a huge risk component that comes with chasing higher returns. And I've always said on this podcast that I only want the market return. I don't want to beat the market. I don't want to lose against the market. And so I always use the market as my base case, right? So if you were going to chase returns above the market, you are going to be taking on additional risk above what the standard market risk is.
Yeah. You've actually used the word greedy, Andrew.
Mm-hmm.
You've said, which I think is a unique spin on it, right? Like I've even talked about that I've had, a big chunk of my 401k in VUG, which is VUG, and it is significantly higher weighted of tech companies, essentially. And so it's got a lot more risk on it, right? Those companies are arguably overvalued, blah, blah, blah. I'm not going to get into that, but it has had a significantly higher return than the total market over the last, 5-10 years. But that does come at a higher risk. And you've said, I don't want to be greedy. I want my fair share of market returns.
Right.
And that's not a unique point of view, right? That's a very common point of view, particularly even, I think, in the FIRE space.
That's an uncommon.
Oh, that's fair. No, you're right. That is fair.
And like, here's my thought process on this is that when I've gone and crunched the numbers, that if I just get the market returns, that we will be more than fine. So why do I need to chase more than that?
Yeah.
Given our lifestyle and where we're at, I only need the market returns for if what happened over the last 30 years, which you could argue and the market won't return as strong as it has been the last. But even if we're not getting 8, 9, 10% returns, if we're getting 6s and 7s, which is a fairly conservative point of view, right? That I'll be okay with 6 and 7. So I don't need to be, we don't need to be chasing, certainly not a 15 or a 20% return. And then I think it does come down to greed right?
I think it's fair. I also think you are a practical person and you don't want, you've talked about this before too, you don't want the headache of what comes with that risk. You don't want to be stressing about the fact that you tried to get more than your fair share. Yeah. And then you're constantly thinking about it. You're constantly, second guessing yourself. So there's a lot of emotional and mental turmoil that comes with that. And, one of your favorite books, Andrew, is called The Simple Path to Wealth. It's the simple path, right? There's a lot, that's kind of what we're talking about today, right? There's a lot to be said for the simple path, and it is definitely the path you and I are taking, right?
Yeah.
And just to double click what we were just saying about risk and reward, if an investment guarantees huge, fast returns with, quote, no risk, quote, which quite honestly is what this thing that a friend of mine pitched to me, it is either a scam or it is lying. I'm not saying someone was, purposefully lying, but it is discounting the true amount of risk involved, right? So this particular approach somebody's talking about, it had some very big assumptions in it, and it had a lot of risk in it, right? And so when you are promised higher returns or someone claims they're going to get you higher returns, that normally comes with a much larger amount of risk on those returns. Nothing is risk-free, right? It's all about your comfort level of how much risk you are willing to take on. And let me give you a very specific example of that risk. When I went to go look at something in Fidelity that was related to what this person was recommending, they were recommending doing their own covered calls strategy, but there are some funds where you're essentially buying into a fund like QQI or SPYI, where it's a managed fund where someone is doing the covered call strategy on your behalf and charging you a 0.68% expense ratio, which is pretty high, right? It's close to a financial planner, but arguing they're going to get higher returns. If you go into Fidelity and try to buy this fund in your brokerage account, you have to go in and sign this designated investments waiver. And let me tell you what it says. I'm not going to read the whole thing to you, but let me just give you the Cliff Notes version.
There's some good stuff here.
By clicking I agree below, you represent and agree 1, I'm a sophisticated, experienced investor. I don't know, that's up for debate. 2, my risk tolerance is high. I can afford to lose some or all of any investment I make in a designated investment, and I have sufficient resources at Fidelity or elsewhere to sustain such losses. 3, I'm responsible for educating myself regarding designated investments, including reading the applicable offering documents, including where applicable, the prospectus, blah, blah, blah. I've never read any of these documents. 4, I independently analyze the risk of investing in designated investments, and I have the sophistication and experience to do so. I don't believe the average person has this, which is why, myself included, to be clear, which is why Fidelity's putting this huge disclaimer out. Number 5, Fidelity does not, and I understand will not, advise, recommend, or solicit any transaction in a designated investment. So it goes on and on and on. But the point is, even when I saw this, I was like, wow, even Fidelity is trying to cover their own butt on how risky this stuff is. They're not even recommending it. That when you read it, you're like, you're not even recommending that I do this, right?
Uh-huh.
And I just think that was like very telling that even a big company is like, I don't know about this. This feels risky.
Be careful. The waters.
Be careful. Yes.
The waters may be shark infested.
So I think the other point that is worth reiterating, and you briefly said earlier, Andrew, is the idea that people are preying on our emotions with some of these strategies.
Yeah,
and products,
100%.
Right. They're not selling strategies. They are selling hope. They are selling FOMO, fear of missing out. They are preying on our desire to fix our financial struggles instantly and quickly. The idea of getting rich quick and making up for lost time, which, I started investing not till my, mid-30s, later than I'd say average, particularly for someone who, retired early in their early 40s. And there's a lot of people that get into things late and then they want to make up for lost time. And there are a lot of people that will prey on that desire to get rich quickly and get in our heads. And you can't see me on video, but I'm pointing to my brain here, right? And they want to get in our heads and they want to convince us that, like, we need to get in on this,
Yeah.
And like you saying, people say, I got exclusive access to this.
Yeah, and social media certainly does not help this situation at all.
Yeah.
That the more extreme the position, the bigger the microphone becomes, and this people know that this sells, that they're preying on those emotions, that people are always trying to find the fast and quick way out, right? And man, the influencer videos that come up on my feed around some of this stuff is just scary. When it comes to Forex trading is a popular one. I've seen people talking about different tax strategies, talking about, I just had one just tonight come up of this influencer talking about their quote tax strategies. And
right, because they heard us talking about this
right
day,
and so they're trying to sell their classes. They're trying to sell. There's always something behind. There's always a motivation behind it, right? They're not doing this just for the good of the internet, right? We're going to put this out there, and like we said earlier, if there was a money printing machine, I certainly wouldn't be telling anybody about it. And so I think you've just got to have you have to have your guard up all the time, and you have to ask yourself some tough questions about what the motivations are of some of these influencers, and are they really, what are they peddling, and why are they peddling it?
And look, I'll give credit where it's due. Some of these influencers are good. They're compelling. Like, they're good at putting out a quick sales pitch and like convincing you.
And they always do it with their $3 million mansion in the background and their Porsche in the driveway, right?
Yeah. Like, you want to know how I got this car? So we'll talk about some red flags to keep an eye out for. But before that, like I think you said something similar to this before, Andrew. Like, look, if you're an influencer and you're trying to sell me your course about Forex trading or whatever, if you were making so much money off Forex trading, you don't need to put a course together, because that's a lot of hard work.
Yeah.
It's a big hustle to be an influencer. If you're influencing on that, you're likely not making money on that product. You're making money off selling a course to something that, again, I know this is like a whole circular logic you got to follow here, but like, if you were making so much money off doing that thing, you probably wouldn't be. You're not just making a course to like spread the wealth to other people,
right?
Or if you were, you wouldn't even need to sell the course. You'd just give it away out of the kindness of your heart.
Yeah, and I think right. And real estate is a hot button for these. I've worked with some financial coaching clients of mine that have gotten themselves into this, where It's all about how many properties can you amass? Forget the debt. Who cares about the risk of the debt? And suddenly people are upside down, crazy on their cash flow. They're getting crushed by the debt, and so there's a lot of this in the real estate space.
Yeah, and there's like people who exclusively make money off selling conferences to teach you how to make money off real estate, which again, I've heard really negative reviews of some of those. Not all of them, but some of them.
Yeah.
And I think Erica and I talked about some of this in like a predatory marketing episode we did that we'll put a link in the show notes to. So I think it's worth going through a few other red flags to help you spot these schemes, right?
Yeah. And just before we get into each of these specific ones, the overarching one here, if it sounds too good to be true, it is 100% guaranteed.
Yeah.
And yeah, I'm happy to have a listener try and prove me wrong on that, where it wasn't luck. But I've never seen something where if it sounded too good to be true, it actually turned out to be true. No, it's if it sounds too good to be true, it is.
Well, and we can't promise this with everyone, but I would also say if you see something amazing and you're like, oh my God, this sounds awesome, like send it over to Andrew and Maggie.
Yeah, right.
Hit us up on Instagram.
Hit us up on Instagram with your best pitch.
Yeah. And like, if you see something from someone else that someone's trying to sell you, like send it to us and be like, hey, would you do this? Does this sound like on the up and up?
Maybe we do that as an episode. Have the listeners send in their best pitches, and then you and I go through an episode and we critique each of the pitches and see whether we would invest in it or not.
Yeah. It'll be like a mini Shark Tank. But,
right.
And like, we're not assuming it's even your personal pitch. We mean like someone pitched you on something and you're like trying to decide if it makes sense.
Yeah.
That's a great idea, Andrew. So yeah, send us your stuff. We've got a email address. You can send it to Maggie@insideoutmoney.org, or you can send it to the phone number that we share at the end of the episode. It's all on the website. Okay. Couple of red flags though, in addition to if it sounds too good to be true, it likely is. If there's a lot of upfront fees and payments and you have to pay them to start making money, hard pass on my point. Right?
Yeah.
Hard pass.
Yeah. Yeah. The radar is buzzing.
Yeah. I think also a big red flag is when it's this like secret or exclusive offer, right? If it's truly
and it's only
guaranteed, available
for 3 days too.
Yeah. And if you don't commit now, the price is going to go up.
And
tomorrow,
there's only 40 spots.
Yeah. Right. If it is truly guaranteed to make everyone rich, it wouldn't be marketed to you on some random feed, right? Like, and again, I'm taking a little bit of like a pessimistic attitude to this. I'm not saying there isn't some good idea out there. I'm not saying somebody hasn't made money off this stuff. Again, it's luck, and we're not always luck, right? But often it can be luck, misconstrued as, that something better than everybody else knows. And we are big fans of the simple path, which we'll get back to and we'll wrap up with. And then I think another huge red flag is when it focuses on you having to recruit other people. So like multi-level marketing schemes, as people often use the word schemes, pyramid schemes. And, they make money off bringing in new people. They make most of their money often off that, not actually on selling products. They make money off the sales force buying product, and they don't really care if you ever sell it to an end consumer. And the people that make real money are at the top of the pyramid, and people at the bottom are all losing a lot of money, and that's how they make money. And again, if to make money, you've got to recruit a bunch of other people, like huge red flag.
Yep.
And I think overall what we're saying is the average person should not be doing these things, right? Like, let's go back to that disclaimer I read from the Fidelity website, right? If you would click yes to all those things, well, then maybe you want to dig into something, but I wouldn't click yes to all those things. I mean, I did for the sake of wanting to play around with even looking at it in Fidelity, because I couldn't even get past it without accepting that screen. But I'm not going to do that, right? I'm not going to buy a bunch of that product because I still believe in buying low-cost index funds personally. Okay, we will wrap this up with sharing what we recommend you do, which we've talked about in a million other episodes. We're going to remind you here. Since we're telling you all the things we wouldn't do, we'll go back to why the boring basics are actually so great. But I like to get your thoughts on this potentially fine line between some of these investment schemes and gambling. Like, do you think this is comparable to gambling?
Absolutely. And if you I always love using the example on Reddit of Wall Street Bets. So the Wall Street Bets subreddit, literally bets is in the name. And there are all these people on Wall Street Bets that are day trading. They're doing options trading. They're taking huge risks with massive leveraged positions. And that subreddit is a great insight into the psychology of get rich quick investing. And you'll see people posting where they started with 5,000, they turned it into 100,000, and then it fell off a cliff, and now they're upside down, and their account's been closed. The Robinhood account has been closed, and they're now in a really bad situation.
But they were riding high for a while, right? And they told everybody else about it.
And if you remember, I don't know if you remember, it was during COVID. It was like 2 years ago. This user on Reddit called Roaring Kitty made a ridiculous amount of money betting on GameStop. Right, the whole meme stock thing happened, and it was mind-boggling what he did, and so these people get put up on these pedestals with, hey, this is the strategy and approach to take. And there's no better example of get rich quick than the Roaring Kitty example on Wall Street Bets.
Well, and if you're not going to go read what Andrew's talking about, you could go. There was a whole documentary created on it.
It is fascinating.
The title gives it away. It's called Dumb Money.
There you go. I actually haven't watched it. I need to go watch it. I love it. It's really good. Fascinating story.
I've watched it before, and the actor in it is really good. It's I think it's well done. It's on Netflix, and I think there's been a number of documentaries on it also, because there's also Eat the Rich, the GameStop saga. But Dumb Money is an actual it's where they remake it. It's it's a comedy.
I watched
drama.
Eat the Rich. That was good.
But Dumb Money's more of it's a drama,
okay.
But it's a reenactment of that. There's an actor playing the Roaring Kitty character. And it's good. You should watch it.
Yeah, so I definitely think a lot of this stuff is no different than the roulette wheel in Vegas when it comes to day trading, when it comes to the options trading that many of these people are doing, and the forex trading markets. Now, also, I just want to put a disclaimer out there: the options market and the forex market have a very specific, defined purpose in the economy, and there are very good and valid reasons of why you'd want to be doing options or hedging with foreign currencies. Foreign currencies in my last job was a huge thing, and there are many companies that will hedge against it to smooth out their overall returns. But for the way most people are doing, most individual investors, it's the roulette wheel.
The people you're talking about, Andrew, are highly trained professionals. That is what they have chosen to do for a living.
The commodity trader at Delta Airlines who's hedging fuel options. Highly skilled professional. The 18-year-old on Wall Street Bets who's betting on the price of oil or the price of gold or the pound or the euro, where it's going to go. Very different situation.
Yeah. Or the 30-year-old who wants to start investing more and wants to grow their wealth, that gets tempted by, these various kind of schemes and opportunities that they might see an influencer talking about, or even a close friend talking about. We believe there's a better path. And look, there are some people who love the thrill of the chase, and they love and thrive on that challenge and complexity.
And that's what Wall Street Bets is completely about. They love it's a game for many of these people. Now, unfortunately, they're playing with real money, but definitely the thrill of the chase is 100% part of this.
And Andrew, you're a smart guy, but do you love the thrill of the chase, or do you like the simple?
With my own money, the simple path, right? Do I like being a spectator of Wall Street Bets? Yeah, sometimes it's actually it's entertaining to see.
Yeah.
Now I get very upset when I know that there's real lives are being impacted tremendously. Yeah. When you see someone who's in their 20s post on Wall Street Bets, they just lost their life savings, or even worse, they leveraged they took a home equity loan out on their right. I mean, just insane, right? Or they took grandma's inheritance of $25,000. They put it in because they were trying to 10x it, and suddenly it's gone, and now they can't pay for college. Just the stories are awful, right?
Yeah, it's scary. So I think the reality here is that for the average person, which again, we're going to keep saying for the average person, which I consider myself the average person, even though I like to think I'm above average. Same with you, Andrew. And this stuff we're talking about here leans dangerously close to gambling, right? And we don't believe it is the path to wealth.
Yeah.
Right?
Agreed.
So let's remind people what we believe the path to wealth is and why we personally embrace what I would call like the boring basic stuff. We said this at the very beginning, Andrew, and I'm going to repeat it now. People have a hard time conceptualizing that the easiest, most uncomplicated strategy is the best. You said that to me on Monday. And then I wrote it down. I was like, that sounds great. And then that was the one where you were like, that's what Morgan Housel says, or some version of that, right? And I think there's a lot of value in focusing on the basics.
Yeah.
Right.
I mean, it doesn't get any simpler than spend less than you make and invest the difference. Invest the difference in low cost index funds. It's one sentence, and I'm not gonna sit here and say it's easy, because the FOMO is real, and it definitely takes discipline to put a wall around yourself with all the temptations of, well, should I be investing in this real estate asset, or should I be buying this hot stock that Uncle Jim said, hey, you should be buying this, right? I mean, there's no shortage of temptations when it comes to investing, I started VTSAX investing in 2010, and so I've been doing it for 15 years now. And has it been easy over the 15 years to say that I'm only going to be putting it in VTSAX, I'm not going to do anything else? No, it's hard. It's hard because you're constantly bombarded, especially if you're paying attention to the markets like I do. And you don't, listen to CNBC and you're host, right? But there's certainly those temptations. But what I've learned, and it comes back to that concept of not being greedy and just being satisfied with the market return, is that the past 15 years, the market has returned extremely well, and I'm extremely pleased with just the market return. And so I'm extremely satisfied with that. And so that gives me the confidence in the go forward strategy of I just want and need the market return. And so that is what grounds me in my strategy and my approach to help ward off all these temptations, right? And I come back to it all the time to say, this is my strategy, this is what I'm trying to execute against, and try and have that wall up to shield out the noise.
So I think you said that beautifully, Andrew. And I think we tend to overcomplicate finance because we equate complexity with superiority. And people think, well, it can't be that simple.
And also, I'm only talking about what the investment allocations are, right? There's a lot more complexity when it comes down to 401k versus Roth, or HSA versus, what am I going to do? That type of stuff. There's definitely a lot of complexity, but when it comes to what is my asset allocation and where do I want those assets, what classes do I want those assets to be in, the approach couldn't be simpler. But there's a lot of complexity when it comes to the different buckets and where you should be contributing. Taxes is a whole nother piece, right, of complexity.
Yeah, tax
all that is there. Yeah, but when it comes down to what should my investment strategies and approach be, it's the slow tortoise wins this race.
So Andrew, when we were talking the other day, you made a comparison to cycling training.
Yeah, and so with my athletes, I have to work
Let me clarify, you say you're athletes.
So,
you've been doing
so I do
cycling
coaching in addition.
Because you're award-winning. Is that award-winning? Is that you're a champion? You're a U.S.
12-time
champion.
U.S. national champion. There you go.
There we go. 12 times. You don't want to say it, but 12-time U.S. national champion.
And so I coach. I've got 11 athletes that I coach. And when I'm designing their training plans, some of the athletes who come to me from other coaches are sometimes a little surprised at how simple my training plans are. And I have to explain to them that many coaches will put together extremely complex training plans and training schedules to justify their coaching. And this is very similar to my job as a financial coach as well. When I'm working with financial clients, is my job is to help simplify things, and that again, it's a simpler training program is actually the best approach.
Yeah, that is literally what financial planners do, and why I'm not always a huge fan of them.
And so that's one comparison to cycling. The other one is that consistency is probably the number one factor to performance when it comes to endurance sports. If you can build consistently over not just months, but years, you can drive performance that way. And so it's a consistency around not only your training, it's a consistency around your nutrition and all of the little things that add up.
Rest.
Right? Sleep, rest, all of it adds up. But if you can consistently do all those small things, you will drive performance. And so it's similar to that approach when it comes to investing, where if you can consistently contribute a small amount every 2 weeks or every month into the market and dollar cost average your investments
as early as possible. If you've missed those early years, the next best time is now.
The best time to invest is yesterday. The second best time is today. And so if you can follow that approach where you start early and you are consistently dollar costing into the market, even in very small amounts. You pull up some of these calculators and you can see if you're just putting in $100, $200 a month in your 20s, and the magic of compound interest, right? And it really adds up very, very quickly.
And that is what some people would say is the boring, it's not super exciting, it's not super sexy. It is the boring, simple, consistent path that does grow wealth over time. So if you can consistently spend less than you make and invest the difference, and not invest the difference in super risky stuff, right? As we've just, talked about on this episode, right? You will grow and build wealth over time. And that is the path that we recommend, and many other people also recommend. But also, many other people try to sell you something much more complicated, which, we won't go back to that point. Because I think we've landed this plane, Andrew, or I was trying to think of some cycling. How do you land a bike? We finished the cycling race. Yeah. There we go. We finished this race. So
cross the finish line.
Onward. Yeah, we've crossed the finish line. So thank you all for listening. We always appreciate you spending some time with us. Everyone's got limited time, so it's a big deal to us that you choose to spend some of it with us. If you've enjoyed this episode, we always appreciate it if you want to leave us a written review on Apple Podcasts or a rating on Spotify.
We also encourage you to share this episode with a friend or family member to encourage ongoing discussions about money. You can also subscribe wherever you listen to podcasts. If you have thoughts or questions, we'd love to hear from you, and you can leave a voicemail or text us at 404-981-70 or hit us up on Instagram.
Awesome. Thanks, Andrew.
Thanks, Maggie.
Bye.
Bye.